Welcome to Opal TV. Today I'm in Zurich together with Ilario Casascia. He is the portfolio manager of the Harcourt Alternative Leaders Fund. It's a strategy-focused fund of hedge funds with an impressive track record since November of 2000. Ilario, please, to start off, please give me your background and tell us more about your fund.
Harcourt is the alternative investment competence center of Vontobel Asset Management, which is a leading asset management company in Switzerland, managing around 100 billion. Harcourt itself is managing 3.5 billion of assets within the alternative investment area. I joined Harcourt in 2010. Prior to that, I was fund of fund analyst at Quadriga Wealth Management in Pfäffikon in Switzerland. And before that, I was a management consultant at Bearing Point. And my first career step was at Credit Suisse. We started managing a strategy-focused hedge fund portfolio for a very large Swiss-based pension fund in November 2000. Since then, we can show a very successful track record of the last 15 years with a cumulative return of around 120%, which translates in 5.2% annual returns and a volatility of around 4.5%. So during these years, we have been approached by different institutional clients with interest having access to this portfolio. The problem was that it's a single investor vehicle, so we couldn't let them access this portfolio, and we came to the idea to replicate, to mimic this portfolio through fund structure. This fund structure has been realized last year. The fund is called Harcourt Alternative Leaders Fund, and it's an onshore in Luxembourg-based fund, which gives access to small and mid institutional clients with a minimum investment of around 1 million. The fund is managed by myself and the team, which consists of 5 people, 3 in the investment side and 1 senior risk analyst and 1 senior portfolio advisor.
So Ilario, the Harcourt Alternative Leaders Fund is a strategy-focused fund of hedge funds. You have done a lot of research, you and your team, and also your actual track record shows something that's really interesting. So your approach is actually beating the typical multi-strategy fund of hedge funds. So give us a couple of more data points, or maybe we'll even show a slide, but tell us the rationale for that. How is it that you have the potential of such a large outperformance that obviously also accumulates over time?
Well, we have a strong belief since the origin and the foundation of Harcourt. We think that strategy-focused fund of hedge funds are outperforming and will consistently outperform multi-strategy fund of hedge funds. Why is that? I can give you 2 different evidence. On the first side, the quantitative evidence. We do exercises on an annual basis and look the top quartile average performance of all strategy-focused fund of hedge funds with their peers and compare it with the top quartile average of the multi-strategy fund of hedge funds. And what we found out is that for different time horizon between 1, 5, 3, 5 and 7 years, there is alpha generation compared to multi-strategy fund of hedge funds, which can vary between 1 and 3% per annum. That's on the quantitative base. On the qualitative side, you have to imagine that a strategy-focused fund of hedge funds has on average a team of analysts of 10 people, 10 professionals, which are strongly focusing their attention and their work on a handful of hedge fund strategies. On the other side, multi-strategy fund of hedge fund company have around 10-15 analysts which have to cover the whole spectrum of hedge fund strategies. This means less time to network with the managers, less time to identify the really important risk-return drivers, and in addition, which is very important, is the systems and tools they create and they develop internally, most of the strategy-focused fund of hedge funds, they tilt it for their needs, for their requirements. So they have proprietary tools which are covering just those strategies. A multi-strategy fund of hedge fund company may have also a third party or even a proprietary, but have to cover and fit all the hedge fund strategies they use and they research.
Ilario, apart from the returns that absolutely speak for themselves, what else can you tell us about the investor benefits of your fund?
Harcourt Alternative Leaders Fund adds value on 3 different levels. Let's begin with the strategy allocation. We believe the strategy allocation is very important. So we have a very stable, very solid strategy allocation process, which takes in account different parameters like risk, return, and liquidity constraints. So those will be implemented within our qualitative, quantitative assessment and put into a portfolio simulation process. We do change the strategy allocation once a while, which means between 3 and 5 years. And once we have our final allocation, we do apply that to the fund and to our mandates. So nowadays, the allocation looks like that we have 30% in alternative selection, which covers the long-short equity strategies, 40% in the alternative premium, which covers the relative value and the credit strategies, and the remaining 30% are allocated to so-called market timing strategies, which includes CTAs, macro, and long-short commodities. The second value added is through manager selection. On the manager selection side, we can evaluate our results through peer group analysis. Our managers, invested managers, over 3 and 5 years were either in the first or in the second quartile. So we have a results for end of 2015, which shows that on those time horizons, 80% were in the first quartile and 20% were in the second quartile. So what we avoid is poor performers and poor managers, and that's our second added value for investors. The third level of added value we provide to investors is our preferential access and lower fees we have with our fund of fund managers. This means if institutional clients wants to invest in the same managers we are invested, they would pay today 1.6%, including management fees and performance fees, for annual return of 5%. By investing through Harcourt Alternative Leaders Fund, this fee charge will be lower than 1%. This translates in a fee rebate or fee saving of more than 60 basis points, and that's only for annual return of 5%. If the annual return increases, the fee rebates for the end investor can increase to 90 basis points. So this means that our management fees, what we charge with the Harcourt Alternative Leaders Fund, is more than compensated by the fee savings what we have with our managers.
So Ilario, with your Harcourt Alternative Leaders Funds, you select strategy-focused fund of hedge funds. And you do apparently a very good job when you say that 80% of your funds are in the first quartile. So I have 2 questions for you now. Number 1, tell us more about the universe of the funds that you're looking at. So tell us more about the building blocks that you use to build your own portfolio. And number 2, tell us also about your procedure, about your process. How do you identify who are the winners of today that will also be the winners of tomorrow?
We have peer groups for each of our invested managers. So the portfolio is constituted of 7 different managers today. As I mentioned before, we have the alternative selection module, we have the alternative premium module, and the market timing module. On the quantitative base, we do monitor on a very regular basis the peer groups they are. So we have a very extensive database which we built over the last 15 years for each of these fund of funds. So firstly, they need to be in the top quartile over different time horizon, which can be 3, 5 or 7 years. And on the other side, which is probably the most interesting part, is the qualitative work what we do. So we have a very long-standing relationship with many fund of fund managers out there. We do monitor them, we have a lot of conversations, we have around 50 on-site visits per year, we have around 100 off-site visits per year with the fund of fund managers. So we try to understand how they operate, how they think, what's the portfolio concept they have, what's the research process they have, and that's very important to us, that we can build a conviction, that we can build a short list in our mind once we need really to change a manager within our portfolio.
What are the liquidity terms of the Harcourt Alternative Leaders Funds? And also, how do you handle the different, because these are all niche or strategy focused fund of hedge funds, how do you deal with the liquidity or a potential liquidity mismatch on the side of these underlying fund of hedge funds?
The liquidity term of Harcourt Alternative Leaders Fund is quarterly with 90 days notice period. This reflects the liquidity of our underlying strategy-focused fund of hedge funds, meaning that we are fully matching their liquidity. What we do in addition is to monitor and to evaluate on a monthly basis the liquidity terms and profile of the underlying funds. This means that for the less liquid fund of hedge funds we have in the portfolio, they may be allowed to have at most 20% liquidity mismatch. For the most liquid strategies, talking about CTAs, global macro, long-short commodities, they might have a liquidity mismatch of only 10%. So Harcourt Alternative Leaders Fund charges 25 basis points management fees. And in addition, 10% performance fees above the benchmark, which is the Eurekahedge index. So the 10% are just charged on the outperformance to the index. If we look back, since 2007, the portfolio had a cumulative performance of 29%. Out of the 29%, 2% is coming from the benchmark, 4% is coming from the strategy allocation, and the remaining part, what we provided to our investors, the 23%, is coming out of manager selection. Because we want to generate added value for our investors through manager selection and not through benchmark. Obviously, we want to add value also with strategic asset allocation and with fee rebates, but our focus since the beginning, since 2000, was to generate added value through manager selection. This clearly proves the solidity of our investment process. We're really proud of the product because we want to provide a diversified, uncorrelated portfolio to investors.